this episode, I discuss the simple yet revolutionary way to adjust your finances to maximize the impact of infinite banking on your life. I'm Nate. I make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everyone, welcome back to the show. We're actually picking up this episode kind of almost as a follow-up to the last one. For those of you who listen to the podcast for any period of time, you know that the last maybe 20, 25 episodes I've been on a roll, and I'm kind of in the groove, and I'm having just breakthrough after breakthrough lately in conceptual understanding of IBC and how I can maximize it and how you can maximize it, and answering the very common questions that we get over and over again, and trying to say, hey, infinite banking is extremely logical, and how you operate inside of it can be extremely logical. All you need to do is learn how to think inside of the new paradigm. And so I've done, with the 4 stages of IBC commitment, the balance sheet transaction mentality, and everywhere in between. And I feel like this episode is the culmination of all of that. And I am going to be sharing my screen on this episode as well. So if you're listening to just the audio edition, like on Spotify or Apple Podcasts, you may want to follow up by going and heading over to YouTube to watch the episode, just to get the visual aids as well. But in the last episode, we talked about what infinite banking is really all about. And at its core, at its essence, infinite banking is really all about relegating the banks to do only what they're good at doing, which is simply facilitating transactions. The only role that a bank should play in your life from here on out, now that you have seen the light and you know that there is a way to become your own banker, now you have a way out of the traditional banking world that we live in, and you can relegate the banks to do the only thing they're good at doing in the first place, which is facilitating your transactions, facilitating your payments and your personal expenses. Or as a corporation, if you own a company or something of that sort, then certainly in the corporate world, all of this would align well. The bank account should only be used for facilitating transactions. Everything else should be in policy. So here's why. Banks are good at facilitating transactions, but we tend to use them for more than that. They become the de facto capital reservoir when banks are actually horrible capital reservoirs. We shouldn't be using them that way. They've kind of conned the system to force us to use them as capital reservoirs and have created a default. Honestly, no one would sign up to if there was another way. We would not use banks as the de facto capital reservoir. We wouldn't, because we know what they're doing. We know that we put money in there in deposits into our bank accounts, and they pay us one rate while they go take the money and go earn much higher rates of return on the spread. So they take our money at 2% and they lend it out at 5, 6, 7%, and they keep the rest as profit, even though it's your money. It's just a lousy capital reservoir, and they know it. And all I'm saying is we should be creating our own banking system. If there is a way to create your own banking system that profits you instead of somebody else, and it's available to all of us, we should tap into that and utilize banks for what they're good for, and utilize your own banking system for what it's good for, which is the ideal capital reservoir. And so I'm about to teach a framework today. I'm going to lay it out on my screen here as well. I'm going to go ahead and I can click share just so we have it ready. So I'm going to lay this out on the screen. But what I'm going to say is, if you follow the framework I'm about to teach you, I believe that every transaction that you make in the world of infinite banking will make sense. And you can have a framework to follow that says, by default now, I'm creating a new strategy. I'm creating a new systematic way to relegate banks to do what they're good at doing, and to create my own banking system to be as profitable as it can be. This is also based on another truth. While it's true that infinite banking is all about, getting out of the banking system as much as we possibly can and relegating the banks to what they're good at doing, it's also, there's another secondary idea that says all of your capital should flow into your policies first before it's deployed. Just like right now, all of your capital flows into bank accounts and then is deployed from there. All capital should flow into policies before it's deployed, and that there would be reasons why that makes sense. So I'm about to say what loses people is they don't have the correct framework in order to make this actually happen in their lives. And so I want to talk about the framework that I think can help you make every transaction make sense and be very logical if you follow the framework. One of the issues is that most of the time, policy transactions are obvious to me. Like, I know when I'm doing infinite banking in my own life, I know when I should do everything. Most decisions are logical and obvious. Like how I'm going to repay loans, when I'm going to take policy loans, how I'm going to pay premiums, when I'm going to open new policies. All of these things are very obvious to me, by the way. And I find that to a client listening to this, those things are not obvious. They're not obvious to most people. And so they always feel like it's chaotic, like they don't really know what they're doing when they're practicing infinite banking for whatever reason. And so I'm here to say I think there's a framework, and it's a breakthrough. I've been doing it, but I didn't know I was doing it. It was just the framework I was using in my own life. I didn't see it as a framework. And now I'm like, oh, this is the framework. And if everyone adopts what Nate's doing, maybe it'll make sense to them what they should do, just like it makes sense to me on what I should do as well. I think that to practice infinite banking appropriately, every one of us should have 3 bank accounts. There should really be 3 bank accounts in our lives. I'm going to draw this out. There should be 3 bank accounts inside of your framework. And then I'm going to call the first one your expense account. There should be a capital account. And there should be a transfer account. So all of us should have 3 accounts. There should be an expense account, a capital account, and a transfer account. And I think you're going to know what I mean by this as we move forward. So remember, we're trying to create a framework that we can just live our life by, that will make policy transactions obvious and will make using IBC the default banking solution for your life. So in other words, what I mean by this is most people actually have one foot in the old banking idea because they haven't fully transferred over, and they got another foot in IBC. And whenever you're trying to do both at the same time without developing a new framework, like a new default framework for how money's going to flow, you'll go back to the way you've always done it. Like, in other words, if the idea is, as we're building a banking system, we should have our banking system be the centerpiece for all of our financial transactions. But if we don't know how to create the framework to allow for that, we default to the normal way, which is a bank account being the centerpiece of our entire financial life, and policies are just an off branch of the bank account. And it's supposed to be the reverse of it. The bank account is supposed to be an off branch of your banking system, which includes as many policies as it takes to get to the size that your banking system needs to get to. And so I think there's 3 accounts that will make all of this very, very simple. And we're going to use some concepts that I've talked about in the previous 25 episodes. If you haven't listened to all 25 of the previous episodes, you really should. They've been the best episodes we've ever done. If you go back and listen to all 25, you will have your PhD in infinite banking. You should probably go through them twice or 3 times even to really let these all cement. And then honestly, if you listen to the last 25 episodes and this one, and you listen to this one a few times, you'll be like, okay, I get it, Nate. I understand how this whole thing's going to work. And I can rock and roll with it. And you become an expert. And that's my goal. Create a whole bunch of banking experts out there. And so the idea is that we need 3 accounts, and we're going to make some assumptions about this person. We're going to assume that this person has income of $20,000 a month, let's just say, per month. And we'll just call that net income just to make it easy. And we're going to say he has expenses of $10,000 a month. Once again, we can make up any number we want to in this scenario, but we're going to assume this person got 20 grand a month of income, 10 grand a month of expenses, and we're just going to call it a day to keep this very, very simple. So essentially what's going to happen, the expense account, your expense account is really just your personal bank account. It's the one you love, the one you've been using for a long time. I mean, your bills are paid from this account, your lifestyle is kind of funded from this account, everything, all of your personal things go through this account. Normally, this is where we receive our income into this account. And so, in this case, there's going to be $20,000 of income is going to go into this account, and $10,000 is going to go out to pay for expenses, just for you to live your life. And that's what's going to happen just on average every month. What this means, though, is there's going to be $10,000 in this guy's case left over every month that was not spent. And so every one of us has a number like this, by the way. Every one of us has a number where there's money coming in, and it can either be from cash flow from a job, cash flow from investments, even windfalls from investments. Not like appreciation has occurred and you get a big windfall. There's going to be money coming in to your life. Normally, all roads lead back to the bank account, unfortunately, and it's going to come from many different pieces, and there's going to be money that is not spent at the time. This money, the name for that is called capital. And we talked about this in episode 160 and which was the 4 stages of IBC commitment, and also on the webinar. We called it free cash flow. We also talked about this in episode 178 where I discussed how your income and balance sheets are affected by infinite banking. And what I'm trying to bring up, you have income and you spend money in expenses. All of that occurs on your income statement. Whatever is left, whatever income is left from any sort of source becomes capital. That's what it becomes. It's no longer expense money. It's no longer income anymore. So it's not income. It's not expenses anymore. What is it? It's fancy terms called capital. And so in this person's situation, I believe that remember, we are relegating banks to simply become our payment facilitators, not our capital reservoirs. We want all of our capital to flow into policies first as the capital reservoir, and then deploy that capital in whatever else we want to deploy it into. So let's keep going. This means that every single month we're going to transfer $10,000 from our expense account, our personal bank account, that whatever's left over in your instance, and this guy is $10,000 every month, and we're going to transfer it into a bank account that we call the capital account. And in the capital account, the only transaction that you are allowed to make out of your capital account is pay premiums into your banking system. Because remember, the only way to get capital into your banking system is through premiums. That's the only way. So in other words, I've got money in a bank account. It is my capital. It's left over. It's sitting here. I don't want my capital in there. I want my capital in a policy. That is my banking system. I built the banking system as the capital reservoir. Like, that's the whole purpose of doing what we're doing, is to create a new capital banking reservoir in which to operate our life from. And the only way to get capital from outside the system into your banking system is through the premium mechanisms, whether it's base premium or paid up additions, right? Or that's the only way to get capital into your bank. And so this person has 10 grand a month that they're not spending, and it's becoming capital. That's what it is. Whether we like it or not, it is capital. So that means that every single month, or if we use like an annual term, there's going to be a total of $120,000 every year, which is 10 grand a month, that's going to accumulate over time in their capital account. Then from the capital account, we send the money to our actual banking system, which will be a system of policies. Our actual capital reservoir, our actual banking system will receive this in the form of a premium throughout the year. In this case, it's $120,000. 10 grand a month has been accumulating. So that means, and whether you have it all at once, it's at the end of the year, or whether you have capital, premiums come due at various intervals throughout the year. In other words, all we're doing with this account is all capital inflows go into the capital account. Whether it's, in this case, it's a very simple capital inflow. It's just simply 10 grand a month accumulating in his capital account. It's becoming capital every month that he doesn't spend the money. And it's true, in life, you can have capital events where you'll sell off an asset or something like that, and it'll become capital in your account that didn't come from cash flow. It came from having capital situated in other assets and so forth. So I know this is simplified, but this is what helps me make sense of everything I do. And so we've got the expense account. It's just the basic checking account. We only leave, typically, my suggestion is maybe 1 to 2 months of operating capital operating cash flow into your personal account. By the way, every business that you own should also be run this way. So just as you personally have an expense account, a capital account, and a transfer account that all feed and get fed from your banking system, more on that in just a minute, your actual policy banking system, your corporations, your companies should also have their operating account, a capital account, and a transfer account for them as well. That will also be fed and feed your banking system where we want capital to reside fully. So in this case, he's got a capital account. It's growing by 10 grand a month, and the only thing it's allowed to do is pay premiums. Now we have a whole bunch of cash value accumulating inside of this banking policy. We've got a ton of cash value here. As we're building up cash value, I think you can realize, if I've got 10 grand a month in expenses and 10 grand a month coming in as capital to my policy, then now you're starting to see that the default option for you when it comes to spending money on anything relatively significant and every investment is automatically going to be funded from your banking system. And so that means that occasionally we are going to pull money from the policy through a policy loan, and that money is going to hit our transfer account. And by the way, if you've been around us for very long, you'll know this is called your segregated account historically, called the segregated. I'm changing the name because I like the name transfer account more so. Because in other words, the whole purpose of this account is just simply to transfer money coming from your policies and money that's coming back to your policies. But in this case, it's money that's technically not capital money. It's transfer money, and here's how we're going to define that. Let's say we're going to pull out $100,000 in a policy loan from our banking system, our capital reservoir. The banking system is our capital reservoir. All of our capital is meant to flow into your banking system and then be deployed. That's the whole goal of building this out. All of us should try to get it to that size. And so we've got our policy banking system. It's going to lend out a $100,000 policy. We're going to assume we're going to use this money for different things. And so we're going to say, first off, we're going to use this as an example to say, let's make an investment. So we're going to invest $100,000. I borrow 100 grand from my policy. It hits my transfer account. And the whole purpose of this transfer account is to then send the money out to go make an investment that I want to make. So I'm going to go borrow this money to finance an investment. And we're going to just make some assumptions about this investment. We're going to assume that this investment is producing cash flow. That's what we're going to assume. And so this investment is going to produce, and we like to use round numbers, we're going to say this investment is going to produce 10% cash flow. So I put in $100,000 and it's going to send me back $10,000 a year. Let's just call it that. That means that as this investment is producing cash flow, where did we get the money for this investment? We got the money for this investment from our banking system, our policy. So that means as the investment is producing cash flow, where would we want that cash flow to end up? We want it to end up back in the banking system. So that means that as it's producing $10,000 a year of cash flow, so I made a $100,000 investment, earning 10%, sending me a check for 10 grand every year, it doesn't go into my personal bank account where I'm spending all my just basic expenses. It's also not going into my capital account, which is only reserved to pay premiums as capital. What is it going to do? It's going to send its cash flow to the transfer account, and then that account is actually going to repay the policy loan over time. So it's going to repay the policy loan $10K a year, just like it would make sense to. That's the obvious thing it should be doing. So if we pulled capital out of the system and deployed it in an investment, then the cash flow the investment produces, we should send back to replenish the capital in the banking system. But the money itself is not brand new capital, the cash flow yet. Here's where it gets a little bit fun. let's say we did this for, we had this investment, we paid back 10 grand a year. At some point, maybe we'll sell the investment. And then maybe the investment won't be worth $100,000 when we sell it. Maybe it'll be worth $150,000 when we sell it after producing cash flow and we hold it for 10 or 15 years. I hope you can notice something though, that at some point down the road, the policy loan might be almost all the way paid back and we still have the investment. And that means if we sell the investment, we don't have a place to put the money as a policy loan transaction anymore. So what does that mean we should do? Maybe in that instance, in a capital windfall event that hits your transfer account, but there's no policy loan to send the money back to accordingly because we've been making so much money doing this. Now we will move it over to the capital account and use that additional capital to expand the system. Will likely be the route that we will go. Let's do a different transaction. Let's pretend that while we have this going on, we also say, hey, Nate, I need a new car and I want to purchase a vehicle that's going to be $50,000. And so what are we going to do? Well, we could choose to go to a bank and borrow the money, or we could choose to use our own banking system that is flushed with capital because we've been taking our free cash flow that's becoming capital and we've been using it to pay premiums. Those premiums generate cash value. We're sitting on cash value. We say, you know what? We're going to use the policy. We're going to borrow from the policy to pay for this car loan. And so the idea here is this person inside of, by the way, in the $10,000 expense of his life, of this person's life, inside of this budgetary 10 grand a month that's coming out as expenses, don't you think it would be wise that the cost of owning a depreciating asset like a car should be included in your expenses for either every month or every year? And the answer is absolutely yes. And it shouldn't be weird. Like, in other words, it doesn't matter. People get hung up on this because they don't take it fully to its logical conclusion. If you pay cash for cars, some people say, I like to pay cash for cars so I don't have a car payment. In which I'm trying to say that's just actually inaccurate. It's just simply incorrect, unfortunately. Because if you spend 50 grand on a car and you pay cash for it from a bank account, then the only way, so that car's not going to live forever, it's going to die, and the only way you'll ever be able to replace the car is if you have enough money next time to purchase a car. And that means that you have to store some money up. So you have to pay yourself back for the car in order for there to be another 50 grand. Most people don't do that on a systematic basis, but they live on less than they make, money accumulates, and, there's enough money left over because they're frugal and all sorts of things like that. In which case we'd say, all we're trying to point out is that it's been happening under the table anyway. So it should be included as a budgetary item in your expenses. Should just be the expense of having a car. So what I'm trying to bring up is this. Inside, when we borrowed money from the policy to make an investment, we only used the proceeds from that investment to pay our banking system back. And that is logical. It wouldn't make sense to think that you are creating an additional expense in your personal life by borrowing money from a policy to make an investment. It doesn't make sense. It would be illogical to think that that's what you did, because all we're going to do is use the proceeds from the investment to pay back the policy. Some people could say, well, Nate, what if I invest in something that doesn't produce immediate cash flow? Who cares? Just let the loan balance sit on the sidelines and don't pay it back until the investment proceeds come in. Whether you had to sit there for 5 years with no loan repayments, because it's just, in other words, you borrow money to make an investment that's just going to be kind of a flip project, or it's going to sit there, you put in 100 grand, they'll write you a check for 200 grand in a few years. And in other words, you are in control. Don't ever think that you have to change your personal expenses to make an investment. On the same front, it should be a very unusual occurrence for us to use your policies in your personal life in such a manner that would require your expenses or your cash flow to change at all. Let's say we're going to borrow $50,000 out this time in a second loan. Let me erase some of this just so we got... So we've got our investment loan out here. We borrowed 100 grand for that. We're going to take another 50 grand policy loan out of our policy system. It's going to hit the transfer account. We're then going to transfer the money from the transfer account to our personal account, which we're then going to use to purchase the vehicle, because the vehicle is a personal expense. And how are we going to repay ourselves for this loan, for the policy loan. We're just simply going to use the cash flow that's already living inside of your lifestyle expenses, that's been there. If you've driven a car before and you continue to drive cars, you have an expense of driving a car. Whether you've been borrowing money from banks to do it, whether you've been paying cash to do it, whether you've been leasing it, all this doesn't matter. You just give yourself the same deal that you've always given yourself. Let's say this person had historically normally borrowed money from a bank to pay for it and paid them $1,000 a month back on the car loan. What are we going to do? We still have the exact same $10,000 expenses that we used to. 1,000 of that was just our car payments at the time. We're just going to send $1,000 a month back to the transfer account, which is going to send the money back into the policy as loan repayment. None of those are capital transactions so far. I hope you guys are seeing this. So if you have 3 accounts for your life and you follow this framework I'm teaching you, where you have an expense account, which mainly, your income from, earning income, whether you're in business or whether you're a W-2 employee, comes into the personal account. It pays your expenses. Whatever is left is capital. We're going to move that to an account we call our capital account. And the whole purpose of that account is to send the capital as a capital contribution to your banking system. I've said this before in the podcast. A premium's definition should be to us, it's not a deposit. It's a capital event. It's a capital contribution to your banking system. So we should take our capital and use it to make capital contributions to our banking system. Then we will leverage money from the policy and hit a transfer account. And the whole goal of the transfer account is to send money. Whatever we use the policy to do, it's sending money from that account to make it happen. And then the cash flow, if it's an investment, the proceeds of the investment flow back into the transfer account, which flows back into the policy. If it's a personal expense, then the transfer account sends money to your personal account to take over the expense. So let's think of it as like what if we wanted to start using a policy to go on vacation? Well, by the way, a vacation expense is included in someone's personal budget, is it not? In other words, you go on vacations. You were going on vacations and paying for them somehow before infinite banking showed up, and you will probably go on vacations and pay for them somehow after infinite banking shows up. In both instances, they have to be paid for. In both instances, that requires some cash flow to either be set aside in some fashion in order to go on the vacation. So if we borrowed 10 grand out to go on a vacation, then we would typically pay back ourselves with the normal conceptual cash flow that it would go on vacation. Some people would say, Nate, I don't set money aside on a consistent basis to go on vacation. I just have money in my account and we go. And I say, that's great. Keep doing that. But don't pretend that if you use your policies, you are creating an expense that didn't exist. That's what I'm trying to say. You don't have to make monthly payments back to a policy loan that, like if you go on vacation, you don't have to amortize over 12 months. You can just keep doing what you're doing, which is money is going to accumulate in your personal expense account. If you're going to use policies to go on vacation, then money should be sent as it accumulates in that expense account to go back to policies to store up so we can use the policy to go on vacation again. Like, you shouldn't have the perspective of, well, if I use my policy, then I got to pay it back, and if I pay cash, I don't. That's not true. It's the same thing. The reason why we get so hung up is we think we have to follow rules with the policy that we don't have to follow with our own life.
The conventional financial system makes the bank rich using your money and pays you next to nothing in return. At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to become your own bank. Visit livingwealth.com/bank on yourself. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even participants experienced with infinite banking often tell us how they learned a ton too. It's worthwhile regardless of your experience level. Stop letting the banks and Wall Street dictate your financial future. Again, that's livingwealth.com/bank on yourself to gain access to the free course today. Now back to Nate and Holly.
I hope you can start to see the fluidity of this. You don't have to follow new rules. You just have to create a framework that makes sense for you to operate to where these transactions make a lot of sense. For me, for example, I will have investments come up and I have big premiums due every year, about $250,000 of premiums, and it's going to be bigger after I open another policy this year. And so I've got premiums due. It's going to probably be about $350 this year. Is probably what I will contribute to my banking system in the form of a premium, maybe more. We'll see how things pan out. I need to open some new policies. That's God is good. As you make more money, you should open new policies, because as you make more money, your capital account should have more money in it. And so here's the question. If someone says, Nate, how do you know when to start a new policy? Well, if you operate out of this framework, the answer is obvious. Is there money in your capital account that can't fit into the system you already have? If that's the case, now we know, at least we have to start making some decisions. At least we start asking the questions. How did it get there? And we start building out a systematic way to consider the fact that it's obvious to us we need a new policy in some fashion because there's money in the capital account. If you don't do this, and you have bank accounts with money and transactions flowing in and out of them, but you have no way of accounting for yourself how much capital is actually being created in your life, you will never know how much premiums you should be paying, because you'll make up a number. You'll make up a number with no objective. You'll make up a number that I think this sounds good for premiums, whenever you don't have any way of accounting for how much capital is actually accumulating. Because remember, we want the capital in our lives to flow into the banking system first before it's deployed. So here we go. What I'm trying to say is I will have money in my capital account and I'll have investment opportunities that come my way. But instead of using my remember, the capital account is only meant for premiums. So I won't pull money from my capital account to make those investments. I make every investment that I possibly can. Money is coming out of my banking system, my capital reservoir of policies, into my transfer account to go make the investment. If there's like a short time frame where like an investment comes up and for whatever reason I don't have the ability to pull out a policy loan right away, maybe it's like a deal that says, hey Nate, it's right here, we've been waiting for it, but we actually are signing in 3 days and we need the money. Then what I will do is I will pull money from the capital account to make the investment. But guess what? What am I going to do? If I pulled money from my capital account, send it to my transfer account, and then made the investment with it, I am going to pull money from my policy to replenish the capital account to put the money that was capital back in the account. What have I done? I in essence, just in a roundabout way, financed the investment from a policy loan. Maybe I didn't have time to pull money from the banking system from the policy to make the investment. So I went ahead and made the investment and then replenished my capital account with a policy loan. So now it just looks like I borrowed money from the policy to make the investment. That's all that happened. And now I've got my capital accounts back where it should be and I'll pay premiums with it. Now, it maybe takes a few years before this gets fully situated and the body of it gets fully built out. But the idea is if you operate with these three accounts, you have your personal expense account, you have your capital account, you have your transfer account. All of your personal expenses and life expenses get paid out of your personal account. You only leave 1 to 2 months of operating capital there. All the rest of the money that is left over from all reservoirs of cash flow, from investments, from jobs, from everything that is becoming capital in your life, which is just simply the increase of cash that is accumulating in your life that's not being spent, that becomes capital. And then from that account, the only thing you're allowed to do is pay premiums, because we want to use our capital to capitalize our banking system. Then we make all of our capital transactions from policy loans. And we repay those policy loans in a logical way based on the use of it. If it was a personal thing we used it for, then we will take the personal cash flow that was always being used to pay for those things to pay our policies back. And then we will reuse the policy to do it again and put the cash flow back in and reuse the policy again. That's on the personal side. If it's an investment, we're only going to use the investment proceeds into the transfer account to repay policy loans. I will say, to add some complexity, it's possible for investments to produce not transfer money, but actual capital money. And that is possible. As I mentioned earlier in the show, where, hey, if it sells for 150 and you've already paid back all the policy loans from the cash flow, suddenly you actually have 150 grand of capital. So you technically can move that into your, of course, you can move it into your capital account and use it to expand your banking system. And if you operate this way, it's very easy to follow this framework, in which case the hero, the centerpiece of your life, becomes your own banking system that you have built and that you've poured your capital into, and it becomes the true quarterback of your life. That's when it gets really, really, really fun. Some people meet with me and they say something like, Nate, I don't feel like I'm maximizing my system. I don't feel like I'm getting the best results. They haven't borrowed and repaid as much as they thought they would when they started. They haven't made as many policy loan transactions as they thought they would when they got started. And I'm saying, I'm glad that we're meeting, but remember, you don't maximize your IBC system by taking policy loan transactions and repaying policy loans. You maximize your system by how much of the capital coming into your life is flowing through your system and is profiting you and compounding for you forever in a banking world that makes you money, and how much of it is never seeing your system and is only going to and from bank accounts that don't make you any money or very little. And what I'm saying is, you don't have to start where all your capital is going into policy. You don't have to start there. But what I'm trying to bring up is, this is the framework that you have to grow comfortable accepting if you want to advance into bigger stages of IBC. So you can start at stage 1, at the saver stage, and get used to it. Take a policy loan, repay it, kind of get used to the flow. And then start readjusting your life and go to the next stage, and start readjusting your life, go to the next stage. And after a few years, you'll find out that you love being your own banker. You love having a pool of money available to you at all times that's growing and will never stop growing, and it's all tax-free, fully liquid, and I can just operate my life from this system, and I'll carry it with me to the day I die. And when I die, there's going to be a huge legacy event, death benefit event, passing to my family. This is a really exciting way to build wealth. It truly is. I think that if you live your life this way, and you combine infinite banking as your centerpiece with cash flow, producing investments that you enjoy putting money in, you'll become extremely wealthy doing this. And you will blow away any retirement program, IRA, mutual fund style. You'll have more fun. You'll be more profitable, you'll make more money, and you'll build real legacy wealth if you do it this way. In other words, that's why I've said many, many times that IBC is extremely compelling for business owners, entrepreneurs, and active investors, because it fits this so well. If you're a W-2 employee, you can still love doing this. In other words, it's super compelling to everybody, I believe. But I'm just saying it becomes like obviously compelling to a certain subset group. If you are an individual who loves passive retirement program style investments in the market, then you probably just won't get too excited to build your life around this. You'd rather build your life around your retirement programs, or something like that. Which I'm just saying, that's good for you. Good for you. This is for everyone else who's not excited about building their life around retirement programs and having all their capital live inside retirement programs. For everyone else, this is the best way to do it. If you love retirement programs, yeah, you could have retirement programs be where you house all your capital, and so be it. I'm just saying, there's a huge swath of the population who would love another way, and this is the way, and this is the best way that I know how to do it. As I've been bringing up in this conversation, I wanted to end with this. We showed this on a personal situation. Businesses are even worse culprits. If you're a business owner, you can be a worse culprit at violating this. In other words, some people would be on board with their personal account just having 1 to 2 months of their personal expenses. But then you look at their business situation and they've got a lot of money sitting in their corporate checking account. And here's what I'm trying to bring up. Some of that money in your corporate checking account is operating capital. 1 to 2 months of overhead expenses set aside as, just to operate your business. Everything that's not that just simply operating capital is true capital with a capital C. It's capital. It's your capital. It's your business's capital. And you are now using the bank as a capital reservoir, not as a payment facilitator for your business. And this is a problem. So, like, in other words, a lot of entrepreneurs I talk to, they are fully bought in building out this system and building their banking system for them personally, and they'll even use it in their corporation. But they still, there's something maybe hanging up in their head to some degree where they will leave a ton of capital in their corporate bank account. And all I'm saying is your corporation should really do the same thing. It should have its normal operating account, expense account, and it should have a capital account. And the money in the capital account that accumulates there from you being profitable in business should be transitioning into policies. In fact, the business can even pay the premiums on the policies. The business could technically even own the policies if you wanted it to, and have it be just in other words, just the business capital warehouse. Now, I might suggest that you use the business account to pay premiums, but you own it personally, and I could show you how to do that. Because I think there's benefits to owning it personally, and then but just simply using those policies as only corporate policies. So the only time it ever gets used is when you send money to the transfer account and get sent to the business to operate out of. And so the business can have its own banking system. And in other words, you can even mingle it. In other words, you can use your own personal system to lend money to your business. You could have corporate policies per se, capital set aside inside policies for your business. That could be used inside the business as well, and mix and match. But as I was bringing up, I find that corporations are even more guilty of leaving a ton of capital sitting around in corporate bank accounts, using banks as capital reservoirs, which is a logical fallacy to some degree, because they've missed a step. Because they've actually already built a banking system. Most of them already have policies. They're already a banking system established where they're putting a lot of their capital, but they are using the business money and leaving the business capital in a business checking account when it should also be in their banking system and then be redeployed for capital transactions in the business. I think I can help you make sense of this, but if you want to use me as a coach, as a consultant in this, we have to be on a similar page where these things are happening, where you're following the framework, where transactions should make sense to you. If they don't make sense, we need to spend more time together. In other words, Nate should never have to tell somebody to start a new policy. It should become obvious to them. That's what I'm trying to bring up. Like, it's not just Nate's opinion. It's not like Nate trying to sell you a new policy. It's just, it's not that Nate's selling it to you. The framework requires it. The system requires it. Like, if you want to practice the system to its max capacity and make the most amount of money for you and your family that the banking system can make for you, it requires certain transactions to be done and your life to be built a certain way. It's not my opinion. It's just reality. You can choose to not do it. You may not want to do it, and that's perfectly acceptable. And you may not be ready for it at the time. And there's all sorts of things. I'm very sensitive to this. If anyone has met with me, I think it understands I'm very sensitive to all this. But nonetheless, if you want to build your life with a certain framework, this is the way to do it. And so if you go back to my life, and I should have finished out this thought before the very end of the episode. But if you go back to my life, all of my investments I want to be made from my banking system. All of those investments produce cash flow. A lot of that's going to go be transferred back in as loan repayments. But this does mean that all of my cash flow that's generating from my working income and various things, or even investments that produce a large return, and thus there's a lot of capital that's being created that can't just be repaid as policy loans. All of that goes to a capital account. That money is set aside to pay premiums. Then it allows me to live in a situation where it becomes obvious when new policies should be started. It's, hey, if I paid all my premiums for the year and there's money left over, then that means I at least need to start the discussion. Do I need to start a new policy, and what amount should I fund it with? Easy. And then some people are like, well, how do I know the money's going to be there next year, and this and that and this and that? I'm like, well, talk to me. I'm happy to help. But nonetheless, at least you know when to have the conversation. At least it's not Nate trying to sell you something. I'm just merely saying have the conversation. One last thing to note, and I'll probably bring this out more in another episode. Every person watching this should have at least once a year an annual review of your banking system. Not like an annual review with me per se, though it can be with me. I just mean like you should operate with this system like this. And there should be a set date and time where you reconvene your mind to get back on track with your system, and you say, well, how did I do this year in business or at work or with bonuses? Where did all my money go? Should I make some decisions to expand my system? Should I open a new policy? Should I repay policy loans back? Do I have a lot of money in my transfer account that needs to be back in policies? Do I have a lot of money in my personal account that's above 1 to 2 months of expenses? I need to move that out. I need to move that into my capital account. Do I have money left in my capital account? I paid my premiums, but do I have money left in my capital account? If I do, then I need to talk to Nate. He needs to help me get some advice. Is now a good time to open a new policy? I've got money left over that I couldn't fit. All of this, like, there should be a moment in time, whether it's the end of the year, whether it's the end of your policy year, if you have like your first policy anniversary, whether it's tax season, whether it's the start of the year. In other words, all of us should have a moment in time. For me, it's always been the end of the year. I've mentioned this on the podcast, by the way. At the end of the year, I essentially do like a full recap of the banking system for the year. I make decisions at that point, which is why most of my premiums come due at the end of the year, because I'm making decisions at that point on what to do with my banking system expansion, loan repayments, all sorts of things. Whew, well, this was a lot of fun. I hope this was of high value. I actually was a little bit more time than I expected, but man, I really enjoyed doing this. Once again, by the way, I think the last 25 episodes have been some of the best IBC content ever created. If you agree with that, I would love a subscribe, a like, a review. It would just does so much benefit to our world to get the news out there. I think we're on to something. I think IBC is the most powerful thing financially that most people can encounter, and I'm so happy to have encountered it myself and to be teaching it. Be blessed, enjoy living life, enjoy building a bank. It's one of the most gratifying things you could do. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered.
One last thing before we go. Start your journey towards financial security and wealth today. Visit livingwealth.com/bank on yourself. Upon completing the course, you'll have all the information you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/bank on yourself.